Hey everyone, so my name is Michael Manatsakanian. Real easy, right? Manatsakanian. So that one more time for the people in the back. Manatsakanian.
Not
So
surprising.
today we're going to focus on the art of underwriting real estate investments, and we're going to start from an extremely foundational approach. First of all, you know, what is underwriting? Underwriting real estate a real estate investment is determining, is the property you're looking at a good investment or not? Is this a good deal or not? And that depends on the specific person analyzing the deal and what their desired outcomes are. So I'm going to just quickly, Esteban, can you mute everyone just in case? Um,
Yeah, I think I'm going
the
to host if you want to try to mute everyone.
I got you. Boom. All right. So, and I'll unmute. So, y'all, I definitely want everyone to keep asking questions when the time comes and all that. And I'm going to unmute because I really want to hear, I want some feedback this time if possible. So, the point of underwriting real estate is to determine if a property is a good deal or not. That's your job. I would say, first and foremost, that's for people who want to buy and hold real estate. You should have a plan for what type of real estate you're looking to buy, and is that property helping you achieve those goals? Maybe if you're a lender on real estate deals, on real estate transactions, you lend money to people who are going to buy real estate. You shouldn't just lend money to the person solely because you like them. Although, don't get me wrong, I've received plenty of funds from people who have just liked me. But my objective always is to educate them and show them why this is a good deal. So as a lender, you should underwrite your own deals that you're lending on to determine, is that person going to be able to pay me back the way they say they're going to be able to pay me back? Is this deal good enough for me to put my money at risk to help them? And especially in my opinion, I think this was a slight detriment for me as a wholesaler, but is also very good, was been solid for my reputation, is making sure that the deals that I'm wholesaling to others are deals that are worth buying, right? And your job when you're underwriting or analyzing a deal is to determine, is this property a good investment? Because as we get into it, before I get too far into it, I was hoping to see if anyone wants to share kind of what what they're hoping to get out of this training. Because I would really love to hear what are some of the reasons why you joined. Because for me, a big passion of mine is helping people engineer their path to financial independence. That's my ultimate goal, is helping as many people as I can engineer their path to financial independence. And that language is very specific. Um, Financial independence just being, you are not forced to work, although you can choose to continue working, but maybe you're working on things that you enjoy and you have the time freedom to pursue the hobbies and passions and work that most aligns with you. That's something I was able to achieve. Esteban's been able to achieve. A lot of people who are successful in real estate or other endeavors are able to achieve that. And we tend to not stop working. I actually still work a W-2 because I enjoy the work that I do, protecting the San Diego community, our environment. I really value the work that I do. Esteban, and then obviously I'm not done working with when it comes to real estate investing and other forms of investing and helping others. Esteban is definitely not done investing or working. And it doesn't mean you stop working. It just means you have the freedom to work on the things that bring you the most joy. So does anyone, if I unmute, does anyone want to share a few reasons why, maybe even one reason, kind of what are you looking to accomplish with your real estate investing, or what are you hoping to get out of this training? I'd really love to hear from you all. I can check the chat too. Oh,
We got a couple questions, but I would say, most people, whenever they're looking at a deal, is like, what is the very first thing you look at, right? So I feel like once after a while, when you understand the foundation and the principles of like what's a good deal or not, you should be able to, in just a couple quick seconds, you'll be able to tell if it's a good deal or not. So if there's anything specifically maybe you look at, maybe like at a first glance when you're going to underwrite a property to see if it's something, worth your time.
yeah, Ali, you got your hand up.
Yeah, thank you so much for putting this together. This is
Of
my
course.
second round The reason why I joined today, the first one was, pretty patchy with kids and other responsibilities. So I wanted to be mentally present here as well. One thing that I want to take away, right? Even the first time around, I wasn't sure if your tool would be the best one to use in my situation. So the situation I'm in is oftentimes, or it happened twice already, when I'm finding these properties on Zillow. And when I do reach out, it just happens that I get to talk to the sellers. Um, One way I want to see if I can utilize your tool is um, the sellers are considering seller finance or hybrid, right?
Mhm.
Um, how do I analyze it with, you know, uh, will that be better to buy like subject to seller finance versus outright, but not for asking price, but for less? Does that make sense? Could I explain?
Yeah, definitely. So you're saying what are the different possible acquisition strategies for a specific property and what would have the best returns for you?
Right. Would that be like, for example, certain property, would that be better bought seller finance for asking price, hybrid for asking price, or can I negotiate for significantly less and go like a standard route, not
So
create way?
what I always tell people before you even worry about underwriting real estate deals is you have to understand what does your seller ultimately want? Will they accept a property? Will they accept an offer 60% of the value, but it's cash? Are they open to letting you carry their loan in a subject to transaction? I mean, at the end of the day, the seller says yes or no if they're willing to accept your terms or not. From there, once you've narrowed down all of the different possibilities,
Mhm.
that could make sense for that deal for that seller that they would pursue, then it's your job to underwrite specifically for those different strategies, right? This definitely, right? Your goal is to see what is your cash flow, how much money are you going to have to invest, and then what is your cash on cash return on those different strategies, right? If you're doing a cash transaction, you're going to put more money down, but you're going to get more cash flow each month because you're not paying a loan anymore. Is that worth it? I don't know. It really depends on the specific deal. So you have to be able to underwrite that scenario. You have to be able to underwrite if I pay off their loan and only do a straight seller finance deal, I have to pay $50,000 to pay off their loan. Does that investment make sense? Or is it better to keep paying on their loan, on the subject to loan you're acquiring each month? You just have to, once you understand what the seller is open to and is willing to consider, then you have to underwrite and see which of these scenarios, there's no like shortcut to that. You just have to underwrite the different scenarios and see
No,
which one
they're
of those
open
makes the
to,
most.
yeah, they're open to seller finance and the hybrid. So it's up to me, like, which route do I take? Do I go standard? Because I
And
already
it
spoke.
depends
Mhm.
because, right, it's going to just depend once you plug in the numbers to see because there's a trade off. The more money you put down, typically, the less money you're paying monthly. Is that does that make sense for that transaction specifically based on the income on the property and based on the other expenses on the property and how much you have to, if it's a $500,000 home and there's a $20,000 loan balance, but that loan balance still has $1,000 monthly payments, it might make sense to pay off that $20,000 loan, right? If if it's $200,000 loan, it might not make sense to put $200,000 down to pay off that $1,000 monthly payment for that $200,000 loan. So it really depends. That's the whole purpose of being able to underwrite all the various scenarios and just seeing which deal makes the most sense for you. And that's really, as I was talking about engineering your path to financial independence, another big component is being able to engineer like transactions, understanding what are the different levers you can pull, right? Do I pay off all this amount? What happens if I reduce my down payment amount with the seller? What are all these different implications? Like, what are the different levers you can pull in a transaction and which levers can you not pull that don't make sense, and then what does that do to your deal? At least some high level concepts, and then you have to actually underwrite the specific scenario to see, does it happen? One easy example is for a seller finance deal, the more money you put down, the less loan you have to the seller, right? Theoretically, you would have a higher cash flow, but you're putting more money down. So does that higher money that you put down make sense for that slightly increased cash flow, right? Which is going to dictate your cash and cash turn. You don't know until you plug in the exact numbers and find out. So yes, that's the exact reason for the calculator. And the reason why the calculator is so useful is because you can underwrite all these different transaction types: cash, conventional, seller finance, sub two. I call them straight seller finance or straight sub two. Pace loves when we were talking on his podcast. He loved straight sub two. Like, I don't know why, he just thought it was funny, but that's a very common transaction now with low equity on market deals. It's straight sub two deals. Or does it make sense to go hybrid? That's the idea of being able to underwrite all these different scenarios pretty easily. And we'll get into underwriting, as we go throughout the presentation. Was that helpful, at least for? Cool. And then Crystal, do you have a quick question?
Yes, I do. I'm really new to sub two. I'm, learning as I go, and watched Pace like forever. So I have the gist of how things work, but I'm really coming in from a different angle. I'm probably going to be a private money lender at first. And I want to be able to evaluate deals that, students are bringing to me and make sure that I'm investing in something that is going to bring me a profit.
Yeah, so for you as a private money lender, it's pretty straightforward what your profit is. If you're lending it out at a 1-year term for 12% interest, your profit is 12% over that year. But your differentiator should be, first of all, is this someone I can trust that I want to work with? First and foremost, like, you shouldn't work with anyone you don't want to work with. But then secondarily, does the deal that they're presenting me make financial sense for me to get the returns that I want to get? Or does it make sense for me to get the returns I'm expected to get, right? Do they have the monthly cash flow to pay my interest payments on my private money loan, right? And then do they have, like, for example, it's a $100,000 loan at 12% interest, right? $12,000 at the end of the year. That's $1,000 a month of interest that needs to get paid to you. Does that property generate that $1,000 a month to be able to pay you back on your interest? And then when the loan is up, do they have a plan in place to pay back your $100,000 of principal, right? That's the whole point of underwriting, is to see, does the deal make sense that they can pay me out of my cash flow as a lender, or out of their cash flow as the lender? And do they have a plan in place? Are they going to sell the property, refinance the property, refinance me to another private money lender? What's their strategy to pay me back my principal? And can they make the interest payments throughout that holding period?
Correct. And also too, being that I'm new and everything, I'm probably not asking the question correctly, but that is 100% correct what you said. But what I was going for is, like, say you see these postings on the sub two community saying, I got this house for so and so, this and this, or I need EMD, or different things people ask for. How do I evaluate what they put up on those kind of postings? If I want to jump on and say, hey, I'm a private money lender, I can help you out, blah, blah, blah.
This is a different conversation than this training itself. But, because I don't want to get into the weeds for a lot of the people who are at this training. But if it's EMD, it's, you're not really private money lending. You're more transactional lending or hard money lending. Transactional lending, you're just doing a short-term loan, earnest money, deposit lending.
But I might get into a flip.
Usually you're putting, usually they need $3,000 or $1,000 so that they can pay for the EMD, the earnest money deposit, so they can lock up that contract. And then you're going to get, let's say, 100% return, for example. You give them $1,000, they give you $1,000 back at the end of 21 days when that deal closes. Do they have it in their assignment fee to be able to pay you back your $1,000? That's the real question for EMD. You see how it's like different than like private money lending. It's not, does the property itself perform? It's, is my EMD at risk? And is there a sign that he can be able to pay me back? And that one, more than anything else, is reputation and credibility based, because, you know, you're lending, you know, to that individual, and you're, you know, I don't even know how to phrase this. It's really dependent on that person. You'll be able to trust them. You know, yes, you're sending money to title directly, but are they going to be able to do what they say they're going to be able to do in the time that they say they're going to do, especially before the EMD goes hard and you are at risk of losing it? So thank you for those questions. We can have a more specific lending training in the future. So that you've kind of inspired me to have a lender focused training in the future.
All right. Thank you.
Thank you, Crystal. Dylan, you got a question?
Yeah, what's up? Can you hear me?
Yeah, I can hear you.
Yeah, I was just gonna say, so you, I didn't really have a question. I just wanted to say, like, what I, joined the Zoom, what I kind of wanted to get out of it. So basically, I'm doing all dispo now, and I just want to get a better understanding of the properties that.
Hey, Dylan,
Yeah.
you're gonna have to type it in the chat, my man. It's so echoey. I really can't hear what you're saying.
Oh, okay.
It's all right. I'm gonna answer a few of these other questions. Just write your question in the chat.
Okay.
Or your statement. I heard it's not a question, it's more of a statement. But Lisa, you wanted to determine if a property qualifies as a wholesale deal. For sure. I mean, does the property make some type of financial sense? And we'll talk about the different reasons why people buy real estate. Are you meeting one of those reasons? And is this something someone would be willing to buy and pay you extra money for, right? So for sure, that's definitely a part of this. Learn how to comp. We're not going to be focusing on comping today, but that's another skill set that's very vital in underwriting. Jamil Damji has some great content out there. Comping is following a certain set of rules to be able to determine what the property is worth after it's fully repaired. And then you can also comp for the income side as well. How much is this property going to generate in rental income? Learn underwriting. Awesome. Learn how to evaluate, see if I should lend on it. Okay, we talked about that a bit. Make an offer within just a few minutes and beat out other competition. That's great. A lot of times you're not making an offer on deep underwriting. You're making an offer based on the information you have at hand. You're typically going to be able to make an offer if you're trying to do it super quick, unless you have like a mortgage statement or something. You're going to do a lot of assumptions. So being able to quickly underwrite and see if it's even worth your time, that's definitely a part of it. Good deal to lend on, especially in second position. Okay, we'll have a lending one later. Faster analyzing deals. So, like anything, the more practice you do, the more it's like in your head. I mean, I have a lot of, I'm able to quickly underwrite a lot of deals by just seeing some of the terms, just because I underwrite all the time every day. So like to learn how to, yep, that's comping. All right, I'm going to move forward and we're going to start, and then we can touch base with questions later. So I'm going to lower your hand. All right, cool. All right, so let's move on. So who am I? Why should you even listen to me, right? Why are you all here today? So we're going to talk about underwriting. So once again, Michael Manatsakanian. Self-made real estate investor. I really like to highlight that because of the fact that I started with nothing. I credit my mom for a lot of my work ethic and all that. But she was a single mom, and it was me and my two brothers. And, I did not have anything. And I'm first generation American. I've had to work for everything in my life, from school to working to investing to now real estate investing, and to the level that I'm at now. And I really like to highlight that just to show less about what I've been able to do, more of what you're going to be able to do. And a big part of that is I started first real estate investing, learning about it in 2018, reading all the forums and watching the Bigger Pockets podcast and reading the forums, connecting with people in 2018. And that's when I really got interested in, okay, if I want to buy real estate, I need to understand what is a good deal and what is not a good deal. And I spent almost 2 full years just underwriting deals, learning as much as I could. 2020, I bought my first property, which was a duplex house hack in Fairbanks, Alaska, because that's where I was stationed with the military. I lived in one side and then rented out the other, or renovated the other side, rented it out, and then swapped, and then renovated the other side and rented it out. So 2021, my wife and I did the same thing. We did it with a 4 unit this time. And I also started wholesaling that year, starting to wholesale cash deals. And after my second um, multifamily house hack, I went from VA loan to FHA loan. I realized this was awesome. I've got 6 rental properties or 6 units. They're generating a significant amount of cash flow for me. I'm able to live for free. It's great. How do I keep doing more of this? So that's when I got into wholesaling to make additional income. I was wholesaling cash deals in Huntsville, Alabama at that point. And I started learning about creative financing, more specifically seller financing. So I put together letters. My wife and I would write letters and send them to all the multifamily homeowners that lived in Fairbanks, Alaska, hoping to just keep buying small multifamily properties. And I actually locked up my 20 rental cabins up in Alaska, fully seller finance deal. It was a Morby method, so it was a combination of a commercial loan and seller financing. But I was able to buy this property, generating me thousands of dollars a month with no money out of my pocket because I was able to help the seller solve their problem, get them the cash they needed from the bank, and be able to get them monthly payments what they were looking for. 2022, got out of the military, moved to Alaska, or moved back down to San Diego. House hacked another 3 units, so doing it, in less expensive markets like Alaska, and then one of the most expensive markets down here in San Diego. Joined the Sub2 mentorship and really added a ton of creative tools to my tool belt. And then just kept buying real estate throughout 2022 and 2023. Well, with over 42 rentals now, we're going to add dozens more this year as well because of everything the foundation we built and the momentum that we have. So, former wholesalers done over 100 transactions. I primarily am a buy and hold investor now. I was able to achieve financial independence in 2021 at 27 with 26 rentals while active duty in the Army. And I still work my W-2. So although I have achieved financial independence, I really love what I do, the impact I'm able to have on my San Diego community, and it affords me also the work-life balance that I need to pursue my other endeavors. And so I still choose to work even though we've achieved financial independence. So I'm a chemical engineer by trade in Sub2. I'm a leader in Sub2 and a mastermind alumni. Sometimes, people call me the creative engineer because of my ability to structure and craft deals, especially negotiating deals. We've been able to get lots of amazing deals with little to no money down because I'm able to take exactly what the seller needs, structure a deal around that. And as long as it also makes sense for me and my investing goals and my partners, I'm able, those are great deals that we're buying. Something I'm extremely passionate about is helping others engineer their path to financial independence. And that's why I do trainings like this. I've been doing trainings like this since even after I bought my first property, because I was still underwriting dozens. I was underwriting every single small multifamily property in my local market. I was helping other people, military or not, determine should they be house hacking multifamily properties? How should they underwrite that property? What do they need to do to basically do what I was doing at that time? So I've always done as much as I can to help others, doing a lot more from a social media perspective and doing these live trainings moving forward. And my goal for this year is to help over 100 intentional investors achieve financial independence. And for me, intentional is being intentional about knowing exactly where you're at, not sugarcoating it, knowing what your income is, what your expenses are, which your expenses are needs, which of them are wants, so that you can understand what is your actual savings, how much savings do you have to be able to invest with, right? And how much time are you spending at your job, so you know how much financial and time resources you have to be able to pursue the actions, strategies, habits you need to be able to achieve financial independence. A lot of words, but the idea is to be very intentional about where you're at, where you want to be, and the specific strategy, habits, and tasks that you're going to do to achieve that. Say no to the things that don't make sense for you, and go all in on the things that do make sense for your overall goals. And that's why being an intentional investor is so important for me. So just, hear from, did you hear that? Were you able to hear that? All right, let me pause it real quick. So just one of my mentors, Pace Morby, this is a Sub2 student, Joseph, that I was able to help in Sub2. And I just always love to highlight this, hear it from the man himself. So.
Cannot hear anything.
No, you don't hear anything? I know there's an easy way to do it. Oh, well, it's okay. Our main man, Pace, says, I'll tell you what he says. He says, yeah, that man Michael is a genius. Yep, love that guy. All right, well, we'll move on from there. All right, so let's get into it, right? The outline for today. So, what are the different financial benefits of buying real estate, right? We talk about cash flow, cash flow, cash flow. And cash flow is the most important, in my opinion, especially when you're starting to build your financial foundation. If you're lending to someone, you need to understand either if it's a fix and flip, do they have the equity to be able to pay you out, or do they have the cash flow to be able to pay you back? And outside of cash flow, there's other benefits of real estate investing that some people disregard, but it's really important to include those as well. What are the different investing strategies? What makes a good investment? We're going to live underwrite a few deals real quickly. Cash conventional deals, just real quickly. I want to run through the overall concepts. And then I have some sub two seller finance and hybrid examples, but I'd rather underwrite your guys' deals live instead. So we'll do that. And then I'll answer any questions y'all have. So caution, most properties are not good investments. Just because someone has a property, whether it's, you wouldn't buy every deal on the MLS for sure. Most properties are not good investments. They're just a property for sale. Same with creative deals. They're not a great deal just because someone's selling it creatively. There are additional benefits, right? You get the benefits of maybe not having to go through a bank, maybe not having your credit pulled, things like that. But it doesn't inherently mean it's a good investment, especially a lot of these deals that people are buying, sub two deals that are 4, 5, 6% interest rates. You would have never bought that, a couple of years ago. It still wasn't a good investment, but now people are buying it without really understanding, is that a real good deal or not? And then back to intentionality. Does this property actually help me move forward on my goals, or is it actually taking away from what I'm really trying to pursue? So different investing strategies. I'm a buy and hold investor, and simply put, you're just buying a property, you're renting it out, and you're expecting more money each month than you're spending. Can't get any more simple than that. The concept is easy. Then actually underwriting the deal and ensuring that the returns are what you plan they are, and you're not overstating income and understating expenses. That's your job as the investor. So whether it's long-term, midterm, short-term rentals, I mentioned house hacking, where you're living in a multifamily property, renting out the other units, and you're living in one, or you're renting out rooms in a larger home. You're buying, rehab, rent, refinance, repeat. Go look that up online. You're fixed and flipping. You're buying a property at a discount. You're renovating it, and then you're selling it for a higher amount. Yeah, we'll exclude that. Or wholesaling, right? You're putting a deal under contract and you're selling it to an end buyer. You're selling your contract to the end buyer, right? Those are the main three strategies when it comes to investing: buying and holding, fix and flipping, and wholesaling. And they all have to be underwritten differently, but there is overlap, especially with the wholesaling buy and hold deals and wholesaling fix and flip deals, right? If you're focused on fix and flip, you're primarily focused on equity. Focused on buy and hold, you're primarily focused on cash flow, but there are other benefits you should account for. So how do you make money in real estate, right? So there's appreciation, which is simply the property increases in value over time. Debt pay down. So every time you make a mortgage payment, we'll just say a mortgage payment, there's principal, interest, taxes, and insurance. Well, principal and interest are the payments you're making on your loan. The interest you're paying on the loan is tax deductible, but it's not really adding to your net worth. What is adding to your net worth is every single month, someone else is paying your loan payments for you. They're paying down that loan balance. That's literally adding equity into your pocket every single month. One example that I have is I have a property that doesn't generate me much cash flow. Sometimes it's negative, but that property generates me thousands of dollars a month in equity alone, and just from debt pay down. So those are factors you need to account for your deals, but that's not going to help you if your properties are negative cash flowing and you have no ability to pay them back. There's tax benefits for real estate because my wife is a real estate professional. I'm able to offset actually all of our income, real estate or not, because of that. And I can use the depreciation from our real estate buy and hold deals to be able to not pay any taxes at all legally, right? It's not, none of it's illegal. It's just using the legal tax strategies that are available to real estate investors. And the most important one, I'd say the majority of people, what they're focused on is cash flow, which simply is the profit left over from the income after you pay off your loan, expenses, and you set aside reserves. A lot of people have phantom cash flow where they're saying, okay, my income is 2,000, my mortgage payment is 1,900. Okay, cool, I'm making $100 a month. As we'll go into it, this training, that's not actually the case. There's a lot more expenses to owning, buying, and holding real estate than just paying a mortgage payment. And actually, even more importantly, we'll actually provide more context to that as well. So what we're going to focus on for this training is cash flow. So how do we determine what a good deal is? There's two key metrics for analyzing buy and hold rental properties, right? That's what we're going to focus on today is buy and hold rental properties. There's cash flow, which is once again your profit on the property, but it's your income minus the fixed expenses on the property, and then the reserves. You got to subtract away your reserves or set those aside each month, and we'll break that down further. And then, in my opinion, the most important metric is your cash on cash return, which is your annual cash flow. It's your cash flow times 12, right? Your full year of cash flow divided by the money you have to put into the deal to acquire it. And we'll break all these concepts down as we continue to move forward. The third really important metric is your return on investment, which is your annual cash flow plus, if I go back a few slides, it's your annual cash flow plus your appreciation benefits, plus the debt pay down benefits, plus the tax benefits divided by your money invested. But, most people are focused on cash return. You're focused on the cash flow return divided by your initial money invested. But I do want to say there is return on investment, which is, another key metric. So breaking down cash flow, your income is straightforward. It's your rental income, any fees. Let's say you charge pet fees, you have laundry on site, vending machines, whatever, that's your income. Your fixed expenses most commonly are going to be your mortgage or loan payments, taxes, insurance, any utilities, and then property management costs. And then you have to set aside reserves for your property. So when something goes wrong, you have the capital ready as opposed to not accounting for it and then not out of pocket to cover those costs. And those are vacancy, which is you save 8% of on average, you save 8% of your monthly rent on the side in your reserves. And that basically just translates to 1 month of vacancy a year, right? That's what you're saving for, assuming 1 month of vacancy a year. That's what that 8% is. And then your maintenance and capital expenditures, you're saving those as well. Maintenance is like you have to send a plumber out, an electrician out, something like that. And your capital expenditures are over time, your property is going to wear down. So you're going to need to replace the roof, the appliances, the flooring, things like that. And you need to save the funds for it. Otherwise, once again, you think you have income, you have phantom profits. And then once unexpected expense comes up, now you're left paying money out of pocket. So maybe you thought you had a good deal, but in reality, you didn't. So income, we're just going to skip on past that. I leverage Rentometer and Bigger Pockets to get quick rental estimates for a property. If you want to get better rental income, we'll run through how you do that later. But really, that's the first line to just get a rough idea. Are those numbers, are they reasonable? Are they similar to each other? Do they make sense for the rental income on this property? And then you can do similarly to how you comp a property to see its value, its after repair value. You do the same for rental income for properties of similar condition in similar area. What are they renting for currently? Whether it's a long-term rental, mid-term rental, short-term rental, there's just different tools to do that. And then your fixed expenses, right? We talked about your fixed expenses are going to be your property taxes, insurance. In this instance, this property had mortgage insurance account involved in there. You have your water, your sewer, your heat, garbage. This is a multifamily property, so the landlord is covering the utility costs, the shared utility expenses, and then your property management costs. Then you have your variable expenses. Those are your reserves, right? As we mentioned, those are just a percentage of the total rent you're setting aside for these reserves. And a lot of people, especially wholesalers, when they present a deal, they want to account for reserves. They'll just say the rental income is $2,000. The mortgage payment is $1,900. But if you don't account for all these other expenses, you're more than likely buying something that's going to end up costing you money. And it's your job. It's not the wholesaler's job. It's your job as the buyer or the lender to understand that, you need to account for that. So your cash flow is super simple now. All you're doing is taking your income minus your expenses, minus your reserves, and that's your cash flow. So in this instance, it was $740. That's how much money you're making in profit after your expenses are paid for and your reserves are set aside. But cash flow only takes you so far. That's one number in a vacuum. It's great if you can cash flow, let's say $100 a month, but that doesn't really mean anything. There's a huge difference. You had to invest $12,000 to get that $100 a month, or if you had to invest $120,000 to get that $100 a month. If you invested that $100 a month becomes an annual cash flow of $1,200. If you invested $12,000 to get that, you're getting a 10% cash on cash return, right? And we'll explain that further. But if you had to put 120,000, is that right? Did I do that math right? Probably not. 100, 1,200, yeah. If you had to put in $120,000, I think that's it's a 0.1 or 1% cash on cash return. Whatever. The main concept is not that I can do math in my head. The main concept is cash flow only takes you so far. You need to understand, you need to put it in comparison to how much money you have to put in to generate that cash flow. So cash on cash return, right? Your annual cash flow, your monthly in cash flow times 12 divided by your money invested. And your money invested for a traditional transaction is the down payment you have to pay for that loan, the agent commissions you have to pay, agent commissions. If you're on the buyer's end, you can typically have the seller cover your agent commissions, closing costs. If once again, you could have the seller provide you some credits and cover those closing costs, but closing costs on the property and the loan. And then any other upfront ready repairs you need to account for to get your property ready for rental. If your goal is to midterm or short-term rent it, you're going to furnish it out. You have to account for that as part of your entry costs. I also account for reserves, administrative fees. I get more in detail, and we'll get into that near the end of this presentation. So what's a good cash on cash return? It ultimately depends on you. I'll tell you what my goals are, but just to put into perspective, an 8% cash on cash return means if you put in $100,000, you can anticipate to get your property back from cash flow alone in 12 and a half years, right? That's what that translates to when people say 8%. If you say 10%, it's going to take you 10 years to get your money back. 50% cash on cash return, it's going to take you 2 years to get your money back. That's how that works. It's just 1 divided by the percentage return is how long it will take you to get your initial investment back. So the higher your cash on cash return, the more quickly you're getting your money back. That's the concept there. But you have to be realistic too on what's possible. A lot of properties have a negative cash on cash return because the properties do not cash flow. And, on the high end, some properties make 15, 20, 25, 30%. It just depends on that equation, right? Your cash flow divided by how much money you have to put into the deal. Typically, the less money you put in, the better return you're going to get as long as the property cash flows. Actually, not typically, for certain. Less money you put in, you're going to get more cash on cash. You're going to get a higher cash on cash return for the same cash flow. So what return should you look for? That's really ultimately up to you. I say that my goal is at least $100 per unit. I expect more than that, but $100 per unit. So if I'm buying a 4-unit property, I want to generate $400 because anything underneath that is almost not worth it. And there's too much risk if it's if it's $5 a month or $60 a year. It's like, what am I really doing here? Is this even worth my investment? And then the cash on cash return of at least 10%. I want my money to work at least at 10% cash on cash return. And for me, that's because the S&P 500, the biggest index fund out there, stock market investing in index fund generates historically 9.8% return over time. So over a long-term hold. So if I'm going to be putting in the time, effort, risk, and work to buy real estate and hold it, I definitely want a better return than I can get in the stock market. It's a little disingenuous because all I'm accounting for is cash flow. And the cool thing about real estate is you get all the other benefits. But for me, that's my guiding light. And being an intentional investor, this is what I use my barometer for. Should I buy a deal or not? It's up to you what you want to do. I can't tell you what returns you should look for. And I can't tell you if you have a really high W-2 income and the tax benefits are really what you're looking for, or, you're in an extremely amazing market and you're banking on huge appreciation, like that's up to you. I just want to lay out the different ways you make money in real estate, and it's up to you what returns you look for. All right, so where to go from here? So if you want to go buy real estate and be a real estate investor, buy and hold a real estate investor, you need to understand the market that you're operating in. You need to understand what are the average rents, what roughly what is the average purchase price in the area, what are the typical investment returns, and your goal should be to exceed the average returns in your area. Set up your investment goals. Typically, it's better if you base that on the markets you're investing in, because if you're in California and you want 20% cash on cash returns, or if you're in San Diego and want 20% cash on cash returns, it doesn't jive with the returns that you can expect in a market like this. Same goes with Alaska. If you're buying in Alaska or you're in one of my like North Carolina markets, you're going to get higher cash. You're going to get higher cash flow and higher cash on cash return typically, but you need to understand that your investment goals should be aligned with the markets that you're trying to invest in. And then analyzing property. So then once you have those, now you start analyzing deals and seeing, do deals in that market make sense for you? And then does that specific deal that you're analyzing make sense for you specifically? Does that hit your criteria? And then after a certain point, you can't be stuck in the paralysis by analysis phase where all you're doing is underwriting deals now. You're just constantly underwriting, and you're never taking action. At a certain point, you have to decide, this property hit my goals and I didn't execute. Once it hits their goals, you have to execute and trust. You have to trust your underwriting and then be able to execute from there. If you don't trust yourself, get a mentor, get a coach, get a consultant, get someone to help you feel more confident. But ultimately, it's up to you as the investor if you're going to take action. So don't get stuck in the phase where 3 years in a row, you just keep underwriting deals, looking at deals on Zillow, and you never take action. You're becoming a better underwriter potentially, but you're not putting yourself in a position to own more real estate or to have more cash flow or passive income if you're not actually taking that action that's necessary. Learning only takes you so far. So we're going to analyze a few quick deals. We're going to go over a cash deal, a conventional deal, and then I'm going to live underwrite with you guys on a sub-2 deal, so a finance deal and hybrid deal. Additionally, instead of those 3 at the end, I can underwrite your deals for you live instead of doing the deals that I already have there. But we're going to basically skip through cash because that's not the point of this as a buy and hold. You really don't want to buy real estate cash as a buy and hold investment, because if you're buying it outright, you're putting a ton of money down. You're not getting the biggest benefit of real estate. One of the biggest benefits, which is being able to leverage, right? You're leveraging other people's money. Even if you put 20% down, you're leveraging 80% of the bank's money to be able to buy that real estate deal. Typically, the more leverage you have, well, I don't want to tell you guys to go take a ridiculous amount of debt, but leverage is a big benefit in real estate. Because for $100,000, instead of buying one property worth $100,000, you can buy 5 properties at 20% down payment for, 5 $100,000 properties, right? Yeah. So for cash deals, what you're primarily looking at is equity. And equity simply is, what is the property worth and what are you buying it for, right? So if the property is in bad condition, let's say the property is in perfect condition, it's worth $200,000, right? You buy it for $100,000, assuming there's no rehab on it, right? You have $100,000 in equity. 200,000 minus $100,000. You have $100,000 in equity. Typically, you're not buying a property at a 50% discount unless you have to put significant work in. So your real entry cost to buying a property is your purchase price, whatever renovation costs you have to put in, holding costs. If it's not your own money, you're getting that money from a lender, so you have to pay money to the lender to use their money. Any closing costs when you buy the deal, and if your plan is to sell it, you have closing costs there. And if you're getting a deal from a wholesaler, you have an assignment fee you have to pay them. But simply, your main thing with cash deals is your equity. How much is the property worth minus all of the costs it took you to get it to that condition in which it can sell for $200,000, right? And your return on investment is, what is that final profit when you sell it? Your profit, your after repair value minus all of your expenses divided by your total expenses. We're going to move on from there. Just simply equity. You're not going to buy Actually, I know a few people who do buy cash deals in low cost Midwest markets, and they have great cash to cash return, and that aligns best with their investing strategy. They're more conservative investors. They're getting solid returns. It works for them, and they're intentional with what they want to do and how they want to do it. And that makes sense. And they should do that. For most people, buy and hold investing is best when you're leveraging either pretty much the bank's money or the seller, acting as the bank. We're going to skip past all this because who cares? We just talked about it. All right, so here's just a conventional deal. This was a conventional deal that actually I did not buy this one. I did not like this property. I presented an offer and they didn't accept it, which is totally fine. If you're presenting offers on market and they're not getting accepted, if all of your offers are getting accepted, you're probably offering too much. If you don't really want all of your offers getting accepted because unless they're hitting your investing goals, you don't want people to, you want to make sure they're offering actual offers that get you your investing goal. So this one was not accepted. I offered lower than they were looking for and it didn't work out. But this is a 4-bedroom, 3-bath property in Fairbanks, Alaska. The numbers are crazy, right? Because of the fact that it's a lower cost market. Well, for a lot of my Midwest people and all that, you're familiar with lower cost properties. But the total upfront cost for this property were $82,688. And this one was turnkey and ready to rent. So turnkey, I didn't have to put any money to repair it. I could rent it out the next day. So breaking it down, what was the upfront cost, right? So the listing price, the property they were offering, they were offering for $315,000. I had a down payment I had to pay of 25% because this was an investment loan, which was $78,750. And then there was closing costs associated with the property. I had to cover my 2.5% of that, which was $7,875. So for me to get into the property, because there was no other upfront repairs, the down payment and the closing cost was $86,625. At the time, I was able to get a 4.25% interest rate, and the loan amount, which is just the purchase price minus the down payment, was $236,250. Amortized over 30 years, that's an $1,160 mortgage payment. So at least we have the mortgage payment and we have the upfront costs for this property. All right. So from here, my job then was to understand what are the other expenses in addition to the mortgage I need to account for, or in addition to the loan itself I need to account for. So when you're paying the bank on a property like this, you're typically paying your mortgage, which is your principal and interest on your loan, the taxes and insurance. I like to break up the loan from the taxes and insurance because the loan payments are fixed over your 30-year amortization schedule. The amount that's going towards principal and interest is not fixed, right? If you're paying $1,000 a month at the very beginning, the majority of that is going towards interest, $950+ of it, and only $50 is going towards principal of the loan, paying down the loan. But as you proceed with that loan, making those payments over time, more and more of it is going to go towards principal and less of it is going to go to interest, even though your monthly payment is $1,000 a month. Your taxes and your insurance will change over time. Taxes and insurance almost always just go up. The property is going to be worth more, and the government is going to say, hey, your local government, your county government is going to say, hey, your property's worth more. You need to pay us more money for taxes. Same with your insurance, especially I think the average insurance increase over the last year or two has been 20+%. I think portfolio wide, I've seen 15+%. Some of them barely went up, and then others went up significantly, just depending on where it was located. Other expenses for this property, because this was a multifamily that there was no way to split the utilities. I was going to have to cover the water and the sewer and the heat. There was electricity for each of the units individually, so the tenants can pay that. And then we account for management and then our reserves, vacancy, maintenance, and CapEx. And then the rental income on the property. 2 of the units were 1-bedroom, 1-bath that would rent for $1,100. One of them was a 2-bedroom, 1-bath that would rent for $1,400. So my total rent on the property was $3,600. My expenses were $1,385. There's still the mortgage payment that's not included in there. And the reserves were $648, right? So then what we're going to do is go into our cash flow analysis. So you have your rental income of $3,600, mortgage payment, expenses, and reserves. That leaves you with a whopping $405 a month in cash flow. for me, that hit that goal because there's 3 units. I'm generating over $100 a month from a cash flow perspective, but I'd have to invest 86 plus $1,000 that we mentioned earlier. So that $405 a month annualized times 12, right? What's that, like 4,800? That divided by the 86 or $92,000 did not generate me the cash on cash return I was looking for. So all I could do is offer less so that my cash flow goes up because I have less of a loan and I put less money down. And I'll show you kind of what I did next slide. What I also like to analyze, right, your 5.61% cash on cash return is basically your return if your reserves are fully expensed each year, right? Because you want to account for, as an investor, you want to account for the worst case scenario. There could be black swan events. You can have really big worst case scenarios. You can have tenants that are non-paying, all that. But assuming that your property is functioning as it should, and you're accounting for your vacancy, maintenance, and capex, you want to know, okay, if all that's expensed, what is my low end cash on cash return, which in this property was 5.61%. And then I also like to see if I don't account for my reserves at all. Let's say the property's fully rented. I don't need to save for maintenance and capex. What's my highest end return I can get? And that for this property was 14.59%. For me, I like at least 10% on the low end, ideally 15, 20 plus percent on the high end, because I know realistically, I'm going to end up with somewhere in the middle between those two by the end of the year. Typically, because my vacancy is lower than a month, but it's because I'm a good landlord. I take care of my properties. I make sure to market them early, all that good stuff. So it really, depends. Okay, so in this instance, to hit, let's say our goal was 8% cash on cash return, right? So you could have given up and said, okay, it doesn't hit my goal. Or you say, okay, what price do I need to get it to? What offer price do I need to offer for it to hit my investing goal now? So in this scenario, you'd have to ask for 7.5, between around like 8-9% lower than their asking price for you to get that cash on cash return goal of 8% plus. In that market, so everyone's really excited because interest rates were low. Your deals can end up making more sense because your interest rate were low, your loan payments are low. But there was so much competition over the last couple of years. It was hard to buy deals unless you were waiving inspections, you were offering waiver asking. You're not going to ask for 10% off and get your offer accepted. And I rightfully didn't in that market. And for my instance, I ran the risk of losing out on the property. It's your call though. If you say your investment criteria is I want 8% plus, you make the offer that hits that goal, just understanding that you more than likely won't get your offer accepted. I still say make that offer. You more likely won't get it accepted, but you definitely won't if you don't make that offer. All right, cool. We'll skip that. Okay, so the thing about conventional deals, I like to think of things as someone who really understands underwriting and really tries to show people with what goes on, or try to educate people with underwriting. I like to show that there are various levers that you can pull with cash deals, right? Your lever for a cash deal is pretty straightforward. Let's see, lever is not the right word. Lever is the right word, but the different levers in real estate investing are what are the terms of the deal, your offer that you can change to then change the outcome for your analysis in a sense. So for a cash deal, all you can really do is say, hey, I'm going to pay you less money, right? That's the only lever you can change. You can't really, if you know it sells for $200,000 and it's going to cost $50,000 to repair, all you can do is offer them less money to buy that deal. Or maybe there's a wholesale sign-up fee. You say, hey, I can only give you this much to get that. That's your really only lever is the price. Maybe the wholesale sign-up fee if it's coming from someone else. For a conventional deal, it's still pretty fixed. You can only really adjust the purchase price. You can look for a different lender that may allow you to do a 20% down payment. You can potentially own or occupy the property using an FHA loan or a 5% down conventional loan and put a lower down payment, but then you have to live in it. The interest rate, the bank tells you what is your interest rate. What's the interest rate you're going to pay on this property? Amortization, the number of years you're going to pay back that loan. Typically from a bank, you can either pay it off over 15 years or 30 years. The lower the amortization, the years it takes to pay off that loan, the worse your cash on cash return is. Well, the worse your cash flow is And yeah, thus the worse your cash on cash return is. And then your entry cost, that's another lever you can ask for. You can say, okay, I will give you that full purchase price, but you're going to cover $20,000 of my closing costs. So it's less money out of your pocket, even though you're taking out more of a loan. In this example, I think what I did was I just put it as 7% or 8% interest rate just to show you that deal that was 4.5% before might have made sense for the right buyer. It really doesn't make sense when interest rates are really high. And so, yeah, these are your real levers of conventional deals. And yeah, so at current interest rate, 7.5%, that property that was generating over $400 of cash flow is now negative $85 a month, right? In this market. And you get a negative cash on cash return because you're losing money each month. Okay. So that's why I love creative financing. You know, creative financing to save the day, because for creative financing, when you're structuring deals and then underwriting them, there are more levers you can pull to make the deal make more sense, right? Doesn't mean the seller's going to accept it. Doesn't mean the seller's going to go from a 5% or an 8% interest rate to 5% to 3%. But you have that option if the seller's willing to play ball. With the bank, they're going to tell you what they're willing to accept. And if the seller's not motivated to work with you, that's fine as well, right? You can't. It's a two-way street. The seller tells you what works for them, and then you have to determine, does that also work for you? If not, you offer them terms that might make sense for you, that also make sense, or that do work for you, that might also make sense for them. And that's literally the negotiation process. For a subject to deal, less levers because there's an existing loan in place. Seller finance is the ultimate type of deal to be able to underwrite because there are more levers for you to play with. And we'll go into all that. So the common creative financing methods, you know, and some of you are in, you know, sub 2 with Pace Morby and you understand creative financing. Some of you know nothing about it, but the main one is seller and owner financing, where and we're going to break these down a little bit further moving forward. There's subject to transactions. There are hybrid transactions, which is a combination of seller and owner financing and subject to, and there are other transaction or other creative financing acquisition strategies. We're not going to really go into those today. We're going to focus on the core seller financing, subject to, and hybrid, the combination of seller financing and subject to. So seller and owner financing is very straightforward. In this instance, the owner of the property essentially owns the property outright, and now they're going to act as the bank. They're going to let you buy the property from them. And instead of you going to take out a new loan from the bank, the lender is going to act as if they are the bank. You're going to pay them a down payment. You're going to pay them monthly payments. You're paying them back. They went from being the owner of the property to basically being the lender on the property. That only works, straight seller financing only works if the property is fully owned by the seller, or the seller has a small enough mortgage payment remaining that it makes sense for you to pay it off. So if they have a $500,000 home and they have $50,000 left on that loan, it might make sense for you to pay off that $50,000 and then negotiate the rest of the terms with the seller, right? So that's where you can have a property with a loan, but because you pay off that loan, it's now just a straightforward seller financing deal. The reason why this is an amazing strategy is because you are able to structure your financing directly with the seller. Like any type of real estate deal, you're able to negotiate on purchase price. Typically, that's the one most of us are not negotiating a ton on because the other components matter more, in my opinion. When it comes to underwriting, you're able to determine the down payment, right? Maybe the seller doesn't need 10%, 20%, 25%. Maybe they need $15,000 for the trip that they want to take, or they need $20,000 for the next whatever they want to buy. You have that ability to negotiate that with the seller. Then you have the monthly payments, right? The monthly payments on that loan to the seller. I don't like to use the language of interest rates and amortization schedules. I just like to know, okay, if I bought it at this price and I gave you this much down, how much would you need monthly in payments for this to be a deal for you? And then I can underwrite from there to see, am I going to make the returns that I need based on my monthly payments to them, all the other expenses I've underwritten for, and the down payment that we talked about, and the balloon, which is just, let's say they're amortized, your loan would theoretically be paid off in 30 years. The balloon is, okay, even though the loan will take 30 years to pay off, they say, okay, at year 10, I want the whole rest of my loan paid off. I don't care if you refinance it, you sell it, whatever, I need you to pay off the whole rest of the loan that you have to me. That's what your balloon is. And subject to financing is when you're buying a property with an existing loan in place, and instead of taking out a new loan from a bank to pay off that existing loan, you're still buying the property, but the seller is keeping the loan under their name, and you're not letting the lender know. You are the one now responsible for the payments on that loan. This typically works out, especially in a market like right now, where the seller is in some form of distress and they're willing to give up their existing loan just to move on from that deal. A common one is, people bought properties with little to no money down in the last, they use the VA loan, FHA loan, 5% down conventional loan, or they bought the property, when interest rates were a little higher or lower, and then they went down. So prices went down in certain areas. So they don't have any equity to sell the property outright. Otherwise they'd have to pay money to sell it. They're even willing to just stop making payments and get foreclosed on, or they're behind on payments. And now you're offering them, hey, what if I catch you up on payments? What if I actually put some money in your pocket? What if I just alleviate your responsibility of paying a second mortgage or this mortgage? Would you let me take over responsibility of payments on your loan? That's all that concept is if it's a straight subject to financing deal. The thing about subject to financing is there really isn't a lot of negotiation. I mean, there is negotiation, but there isn't a lot you can. The big thing you're negotiating is understanding, is the seller willing to allow for this type of transaction, and how much, if anything at all, are they going to expect in a payment to them up front to take over their loan, right? So the monthly payments, the loan amount, the interest rate, the amortization, all that is already set by the bank for their previous transaction they did to take out that loan. That's why there's less levers. It's really, how much do I need to pay you to be able to do this transaction with you? And those are just like the straight scenarios. It's straight seller financing, straight subject to. The most common is hybrid financing. So let's go back to this example. Seller financing, you're buying the property for $300,000. There is no loan on the property, right? You're creating a new loan with the seller, and the new loan is going to be your purchase price minus your down payment is the loan you have with the seller. Subject to financing, you're buying a property at $300,000 and there's a $300,000 loan in place, or there's a $280,000 loan in place and you're paying the seller $20,000 to take over the $280,000 loan, right? So that's all you're really doing is focusing on subject to. More common is you have a property that is worth $500,000. There's a $300,000 loan in place. Instead of paying the seller $200,000 to then be able to buy their property subject to its existing loan, you are going to say, hey, I'll pay you a portion of that $200,000, and I will, and then I will make monthly payments to you on the remainder of that $200,000. So let's say you pay them $50,000 of that $200,000, then you're going to pay them in payments over time on the remaining $150,000. That's the most common, especially in a normal market. What we're seeing right now is a lot of subject to financing. What is also always common is seller financing. But if a seller can sell their property on the market and not have to finance it, unless you're offering them, you're being really strategic about talking about, tax savings, or you're offering them much more than the remainder of the market is willing to pay, it's not as common in a hot market, So your monthly payments on a hybrid financing deal is, you have your money, you pay them down, as the down payment, but now your monthly payment is the loan that you're taking over subject to. So whatever the bank says those payments are, plus whatever seller finance payments you negotiate with the seller. Now that you understand the different acquisition models, the most common ones, seller financing, subject to, and seller financing, at least at a high level, your job is then to understand that what we just talked about is primarily focused on the entry cost. The down payment is part of the entry cost to acquire the property, and the loan payments, whether it's to the seller, the bank, a combination of the two, it's just another expense you have to account for. So the actual analysis is the same overall thing. You're looking at the income of the property, you're subtracting away the fixed expenses, including if it's a seller finance loan, subject to, hybrid, whatever, and you're still setting aside your variable expense, your reserves, and your cash on cash return is still the same concept, annual cash flow divided by your entry cost, but there's more nuance. There's a little bit more variability when it comes to entry costs on your cash on cash return. And we'll expand on that. Okay. So your entry costs, what makes up your entry costs? As we mentioned previously, for a conventional deal, you have your down payment, you have the any agent commissions you have to pay them, any closing costs that you have to pay, and then any rent ready repairs you have to do or furnishing. Well, entry costs can be more complicated for they normally are more complicated. There's more parts to it for creative finance deals because you typically have your down payment or your cash to the seller, which is one of the 8 components. Most people talk about 7. I include an 8th one. You have arrears. So if the seller is behind on their mortgage, there's a lien on the property that needs to be paid off before you purchase it. Those are arrears. Those are payments you have to make at closing to acquire the property. There's any agent commissions. Typically in a creatively financed deal, if you're buying the property creatively, the seller also expects you to cover their agent commissions, or there's a portion of it you will be covering. There's the renovation, rent ready, furnishing costs included here as your rehab and renovation costs. There's a closing costs. Maybe there's not closing costs on a new loan. You still have, closing attorneys, title companies, inspections, things like that. I have an admin marketing exit cost one. Really, it's an admin cost for me. It's when I buy a property, I'm doing it with a new LLC, so I need to set up that LLC. I like to account for my inspection for that for the property. All those are my admin costs to acquire the deal. Because if you're not accounting for these costs, then you're kind of fudging your numbers and making it look like the deal is a little better than it actually is. It's up to you to be as thorough as you can when it comes to underwriting, right? Be true about what your rental income is on the property, true about the expenses on the property, account for the different entry costs, and not just forget about certain components and then be upset when the returns are not what you anticipated. There's an assignment fee if you're buying it from a wholesaler. There's an assignment fee for that. If you're buying it from yourself, you're the one who generated that deal, you won't have an assignment fee. But the assignment fee is a fair and valid payment to the wholesaler because they have to invest time and money to structure this deal that you would otherwise have to spend to structure that deal. So it's something you have to account for and understand that it's an important part for you to be able to buy the deals, unless you are the one who is going to go put in the time and effort and work to structure these deals on your own. And then I also account for carrying costs. I do this, whether it's a creative deal, conventional deal, whatever. I always want to ensure that I have 3 months, the next 3 months of expenses saved up when I purchase a property. That's very important for me. And maybe it's disingenuous to account for that in your cash on cash return, but it's really important when you're trying to raise capital to buy a deal. You want to make sure you're raising the right amount. And that includes the next 3 months of expenses, just in case. It's better to have it and not need it than need it and not have it. So we can go through a straight sub-2 deal, a straight seller finance deal, and a hybrid deal if you guys want to use the terms I have here. Or if anyone has any deals they want to live underwrite, I can use your terms and we can underwrite them together. If you have the terms on deals already prepared, right? You know what the mortgage amount is going to be paid, the interest rate, the monthly payments, you have the entry costs, we can underwrite your deals. If not, we can just use this as an example. If you have anything, please feel free to raise your hand. If not, for a straight sub-2 deal, if you have one for a seller finance deal, please be prepared. Or it doesn't have to be a sub-2 deal. It could be a sub-2 deal, seller finance deal, hybrid deal. If you have any of those that you want underwriting live right now, we can do that. Otherwise, I'll just go through this example. So what I will do, what happens if I slideshow? Let's make it. Oh, Christine, do you have a deal you'd like to underwrite?
I actually do.
Okay, cool. What kind of deal is this?
So this is a sub-2. The seller is in need of selling the property because they have purchased another one and they need the funds for it, but they're willing to accept a creative financing because they're kind of desperate.
Okay, so the first thing we're gonna do, you should everyone, if you haven't already, this might be going away. This might not be a free product moving forward. So go to my Instagram, at Michael MNAT, download a copy, get your free access to the creative finance calculator, get a copy of that while you can. But the first thing you're going to do is you're going to file, you're going to make a copy, and we're going to call it Christine sub to deal. Cool.
I'm sorry, did you say that you have a calculator available that we can
Yep. Free calculator
from?
on my Instagram.
What's your
Michael.
Instagram? At Michael.
Yep. So it's MICHAEL, M as in Mike, N as in November, AT. Michael MNAT.
Okay. Thank you.
You don't have to follow me, but if you want to, feel free.
No, I will. Very helpful. Thank you so much.
Yeah, definitely. So download that calculator. That'll be very helpful for you because it's a hybrid calculator. You can underwrite sub to, seller finance, or the combination of them. There is analysis for conventional loans and instant cash offers. It's pretty straightforward. It's pretty simplified. The focus of this is primarily creative finance. So let's start with the property. Are you cool with us opening it up on
Yes, that's
Zillow or okay?
Yeah, I
well,
believe
it's not under
it's better at
contract yet, is it?
Not quite.
Well, then
I'm
with
getting
70
ready
plus
to submit it.
people, okay, with
Yeah.
70 plus people in live, I would rather not put the address on here.
Yeah,
So,
that's fine.
okay, let's start with what terms do you have?
So I can give you a purchase contract, the payoff. I have the mortgage statement
You have the
and everything.
Purchase price?
Yes.
Okay, what is the purchase price?
434,900.
434,900. Okay, and you said it's a straight sub two deal.
With a down payment. Yes, it's a straight.
Okay, so what's the down
sub
payment?
two. The down payment. Well, I'm sorry. This is where we're kind of like trying to figure out how much we can give them because of the cash flow, the high entry fee. So this is where I'm kind of needing help because
Okay.
the
So
seller basically
what does the seller
wants,
need?
the seller wants all of his equity.
Okay, so what is let's start with that. What is the what is the remaining loan balance?
345. I rounded up,
340.
so yeah.
Yeah, it's whatever. We're just underwriting with your terms. So you said you have the mortgage statement, right?
Yes. Yes.
What is the interest rate on the loan? And I'll fill this into the calculator after. I just want to put all my notes here so I don't have to ask over and over.
Okay. 4.95.
Okay, 4.95%. And then do you know when the first, because if we're not going to look up the address, I can't look up the info I need to. Do you know when the first payment date was, or when on the mortgage statement, it'll say the maturity date, which is basically the date the loan is fully paid off. That minus 30 years is when they made their first mortgage payment. Do you have the maturity date on there? So
on this one, they
something.
did not. Yeah, they did not. They did not. It doesn't show the mortgage payoff, but I can tell you when they purchase it. I have the
just give me a rough idea.
The title.
Yeah.
Yeah, I do.
Perfect.
11/22. Yes. 22.
Okay, so that means their first mortgage payment was probably 01/01/2023, right? Because if they first payment, because when you're buying a property, just for everyone's understanding, if the purchase is near the end of the month, like halfway through the month, typically your next mortgage payment will not be the next month that comes, it's the following month, right? If the property was purchased the 2nd of the month, the 2nd of November, their first mortgage payment would have more than likely been 12/1/2022. Because it was later on the back end of the month, their first mortgage payment was more likely 1/1/2023. All right. And then do you know what the original loan amount was?
Yes, 400,000.
Okay, you are excellent. Thank you for having all of your info. That is perfect. Okay, so now let's start underwriting this deal. So the purchase price is $434,900. We're gonna figure out the down payment after. We're gonna set it at 10% for now, whatever. And now we're gonna figure out the sub two loan info so that we can determine what the monthly payment is based on the existing loan terms. So the loan amount was roughly 400,000. Was that the loan amount or was that the purchase price?
On PropStream, I do show 400,000, but I do have the
Perfect.
PITI.
Okay,
if
and then
you
we
need
can
it.
compare it to that. Yeah. Well,
Yeah.
we'll use the PITI for our taxes, insurance,
Okay.
and their loan payment after. So 30-year term, I'm assuming that's what most people
Yes.
do.
Yes.
So it says the monthly loan payment itself is 2135. What is the PITI?
2429 even.
2429. Okay, so that means your escrow, your taxes and insurance together equal 2429 minus the monthly loan payment, which is 239.92. And I like to say, is it a single family home?
Yes.
Okay. And then your first payment date is typically going to be the month after closing. So right now it's January. Let's say you close this month, your first payment date will be 2/1/2024. I want to show you all how to fill out the calculator as well. And your sub 2 loan payment, the one you're taking over, you said is $345,000.
Correct.
Well, in this instance, right?
I
So we
think
have our
the
purchase price.
400, yeah, I think the 400 loan amount original, I think that's off because if they just got the loan in 2022, that's a significant buy down because usually it's
Yeah, I
you
think this
pay a
might have
lot of
been the
interest in the
purchase
beginning.
price, and they
Yeah, I
probably
don't,
put at least 5%. I would look it up on PropStream, but I really don't want to do that to you since you
yeah,
have
yeah. No, I
it's
mean
not under
on
contract.
yeah, on PropStream, it shows 400, and so that's what I'm thinking. Maybe PropStream has it incorrectly because that's not the right number. It doesn't
Potentially,
make
it
sense.
depends on the state. Some states are non-disclosure states. Some states have more transparency to loan information, purchase information than others. I don't
Mhm.
know. If you
Mhm.
want, we can just say like if it's 345. Well, I can. Is this the actual Is this the actual loan amount right now?
This is the actual correct principal,
Okay,
outstanding
so
principal,
if we set it at, let's say,
and it's
365,000.
4.95. So yeah.
Yeah, so let's say 365,000. If you look at the amortization schedule here, it's going to tell you,
Mhm.
it's going to break down what your loan balance should be now. So it's 359. So if they start at 365 this month, they should be at 359,000.
Okay.
We know
Makes
they're
sense.
over that. So that means our loan was even less than that.
Yes.
Wow. So their loan
Yeah.
was maybe 300. So this is 1/1/2023. Honestly, it's probably 355,000.
That sounds about right. Yeah.
And it says they'll be at 349,715. So 345, it's even lower than that. That's crazy. So let's go to, so we're just kind of trying to guess on where the loan is now.
Yeah.
Unless they paid significant principal payments, which I doubt they did.
I don't think so either.
You don't really do that right away in the first year.
Yeah,
Okay.
you're very
so
close. Wow. This is awesome.
344,789. There you go. We'll say the loan amount was 350,000. So we just kind of
You are
reverse
so
engineered our way
close.
there.
Yeah,
Yeah, so
because
we
it's
reverse engineered.
344,789 to be exact. That's awesome.
Is it? Yeah,
Yeah.
right there. That's what it is. So they bought it. Their loan was 350,000. So either they bought it for 400, maybe they bought it for 400
And put 50 down.
and put 50 down.
Wow, this is awesome.
So
In 1 year, they're selling it
And
for 30,000 more.
yeah, and the thing is, people psychologically will
I don't know, the video and chat was on.
people psychologically will not want to sell it at a price lower than they bought it for. Whether it's right or wrong, people just don't want to do that. So
Yeah.
we'll say they bought it for 400,000, so they put $50,000 down.
It was 499. They just dropped it 2 days ago to that number.
Yeah, people are crazy. So I don't know what to say about that. That's the hard part. You have to
They're
it's got
desperate,
to
I
be
think.
rational. Yeah.
Yeah, they're desperate.
I would say if someone is desperate, they should sell it at the price that will net them to break even and just move on from the property. But I don't know the market. I don't know the property. I don't know what money they put in to renovate it. I don't know any of that stuff. So in this scenario, if the purchase price is $434,900 and the remaining sub 2 loan is $345,000, if you put $43,000, $490, you still have a remainder balance, right? $46,410 is what this says. This means you would have to seller finance this loan. It sounds like they want more than that down. I'm pretty close there. So what you can do is you can just set this value. I mean, now I'm going to have to hard code it, but you could say you want the down payment to be the 434,000 minus 345,000. That means there'll be no seller finance loan. That means you need to pay them $89,900.
Right.
Is that
But they'll
something
be
you want to do?
they're happy to walk away with 45 with no seller finance. So that means we have to adjust the purchase price, and they're willing
They're happy to
do
oh,
that.
they'll do.
They
So then
want
the
45. Yeah.
that's all they want. Oh, that's way better knowing
Yeah.
that info. So let's say this is $45,000.
Plus 45, 390.
Yep. So then we're going to put this purchase price is going to be equal to $45,000 plus your remaining sub two loan, right? So you have to be like a little good with Excel because I can't write for every potential scenario. Like for example, this down payment percentage, this dollar amount is purchase price times the percentage of your down payment. If we want to know what the actual down payment percentage is now that we hard coded the down payment, we could do for 5,000 divided by the 390. You're giving them an 11.5% down payment. Your purchase price is 390,000. Your down payment is 45,000, and your sub two loan is 345. So none of this other finance stuff matters. The loan info will pull into here, so it's 1868 a month, and your taxes and insurance are 560 and 81. Is this a single family home?
It is a single family home.
Okay, so we'll just assume the insurance is 125 a month for now until you get a quote, right? The thing is, when I underwrite, I'm going to get an insurance quote. I'm going to fully deep dive into the property taxes, all that stuff. But if you want to be competitive and quicker, you have to be able to present an offer without all the information, but enough of the right information to feel comfortable with it. So
Do
then
you go
your
off of
taxes.
Zillow? Do you go off of Zillow?
I go off the county. I mean, I'll go off
Okay.
Zillow, and then I'll adjust to that's what this property tax quick estimator is. You
Got
go
it.
off of what the current taxes are and what the price it was assessed at, or what the property value was, and then now you put your new price, and I'll give you your new taxes. Typically, the assessed value is not the purchase price of the property. It just depends on the
It's always
county.
less.
Too
And
hard
it
to
changes
generate.
based on because you're an investor versus a homestead buyer, right?
It depends, depending on the
Sometimes.
market. Yeah, definitely.
I know in Texas it's a huge deal. Okay.
Yeah, some
This is
states
North
it's a few
Carolina.
percent difference. Yeah, that
Okay.
makes sense. So it will be different. So property taxes in this scenario, we know the monthly payment to them is $24.29. We're going to say that minus the loan payment minus the insurance is how much you're paying monthly. So just to clarify, because we're adding monthly amounts here, we're going to change this times 12, and we're going to change this times 12. Okay. So now you have your principal and interest, taxes, and insurance. What is your rental strategy for this property?
So right now I did check the LTR. It's pretty good, 2,800.
Okay, so we're going to change your rental income to $2,800. I personally
good
like
cash
to,
flow.
I personally like to put the, various rental comps. So I'll put Rentometer here, Bigger Pockets here, and then my own, I'll go to Zillow and I'll look up properties that are similar in the local area. What are they
I see
renting
what you're
for? What are in
saying.
similar condition?
Yeah.
So I'll put those
Yeah.
here and it'll give me my average, and then I'll put that there. Without
Got
having the address, we obviously, can't do that.
Okay.
What expenses do you foresee covering? Or if it's a single family home, you're just going to say, hey, you guys cover everything, including landscaping.
Yeah. HOA is $50.
There you go. HOA is $50. So
No solar, no nothing. So we're good.
cool. And then even if you're going to self-manage, I highly recommend underwriting for property management because you may not always want to self-manage.
Okay.
And then the other reserves are vacancy and maintenance and CapEx. On my San Diego properties, I'll go as low as 3%.
Oh, wow.
Because
okay.
I know I'll rent it out before it's even listed, or before the next tenant moves out. My biggest struggle is going to be, can I get the existing tenant out a day or two early so I can clean it for the next guy, or can they clean it early enough? But it just depends on your market. The rule of thumb is 8% maintenance and CapEx, 10%. So,
but you'll use 3, right?
Well, depending on
For
the
vacancy.
market.
Got
Like
it.
in a really ridiculously good market, like the best market, right? Like San Diego is really easy to rent out. So
Yeah.
you have your down payment to the seller. There's no arrears or liens on the property. They're caught up on their mortgage.
Mm-hmm.
Is there an agent involved?
Yes, there is an agent, and we're actually going to get the agent's fees and closing costs paid half us buyer and them, the seller.
Okay.
So
So what is the
realistically,
agent cost?
1.5, so 3%. One and a
Well, but
half
you're only going
buyer,
to worry
one
about
and
the
a half
part you're
seller.
paying. You're going to worry about the part you're paying. So just the 1.5%, right?
Yes, yes,
So it's
correct.
seller agent only,
Closing cost 1.5.
split 50/50. Closing costs, we're going to set it at 1.5. Perfect. Is the property turnkey? I always like to put at least
Yes.
$1,000 for some basic drywall and cleaning. It's up to you what you want to underwrite with at the end of the day.
Okay, got it.
Do
But
you-
it is turnkey.
okay, we'll just leave it at 0. Marketing and exit costs. I mean, I just put the 500 at minimum for like admin costs.
Okay.
And then is this your deal? It sounds like you're structuring this. There's no assignment fee, correct?
Yes, yes.
I like to, for myself, even when I structure my own deals, I like to set an acquisition fee. So I get paid for the work
Yeah.
I did to purchase it. It's up to you if you
I-
do that.
Oh, actually for that
Let's
I'm
put it at
putting
0 for now.
15. Okay,
Let's set it at 0 and then we'll see if the deal makes sense for that. How's that sound?
that's perfect.
And then it's a turnkey property. Are there tenants in place already?
It's vacant.
Okay. Do you feel confident you get it rented out in a month?
Oh
Do you
yeah,
want to set 3
it's
months of reserves, 1 month?
actually it's they don't have a lot of rental, and they said they have a lot of people on the wait list for that location. So I have no
Okay.
problem. It's like San Diego, like you mentioned. So
Okay, we'll set it at 1 month of reserve. So at least you have 1 full month to get everything ready. Okay.
okay.
So for the long-term rental deal analysis, right? You have $2,800 in income, $2,479 in expenses, which are just
The
your
hard cost,
loan
yeah.
payments, taxes, insurance, and HOA.
Mhm.
$280 a month will be towards property management. You could probably get it closer to like 8%.
Okay.
A general rule of thumb is 10%, but in North Carolina, depending on your market, you probably get closer to 8%. But
Okay.
and then your reserves are your 224 a month or 8% for vacancy, and 280 or 10% for maintenance and capex. And assuming
Okay.
you're not using other people's money, right? This
Mm-mm.
deal is negative $463 a month in cash flow.
Oh yeah, when
And
you
you're going
add
to
all that
pay
up. Wow.
almost $60,000 a month
Mhm.
in or $60,000 upfront to buy a negative cash flowing property. Right? Even
Ooh,
in the best
ouch.
case scenario, let's say
Mhm.
you don't have let's say you don't save for maintenance, capex, and reserves. Maybe
Mhm.
you'll cash flow $41 a month,
Okay.
right? Once you
Mhm.
account for the expenses and the property management, you're
Right.
maybe in the best case scenario making $41 a month, and you're paying $60,000 to get there,
Got it. When you say
right?
60,000, are you calculating? Okay, got it. Only 1.5%. I do see that. Okay. 1.5, not the full 3.3, because they're only paying half of it.
Yep. And the cool part about now getting into
Um,
like underwriting and engineering these deals, right,
mhm,
is what levers can you pull now, right? So the thing
mhm,
you can't do is you can't increase your cash flow, right? Because the
mhm,
principal, interest, tax, and insurance are fixed. HOA
mhm,
is fixed. You
mhm.
can't get it less than that's the problem with straight sub two deals, what I was talking about with the levers. You have to
Yeah.
take over at minimum this. All you can do is reduce your down payment to them,
Mhm,
right? Your
mhm,
purchase price and your down payment to them.
mhm.
And that will help
Well,
you reduce your entry costs, but
okay.
that won't net you any more cash flow. What you could do is rent it out maybe as a midterm rental, as
Yeah,
a
midterm actually
short-term
is
rental.
5,000. Midterm is 5,000. I've
Okay, we
already
can
checked.
quickly underwrite it like that. I mean, if you're confident, we could do 5,000,
And for
and
sure
we can
you'll
say
be
that
Kathleen.
management is 15% typically on midterm rentals, 15 to 25%. And the
Okay.
big thing here is typically you're gonna have a lot more vacancy
Mm-hmm.
because there's
Yes.
just delays between, and you have to cover utilities. So what do you
Yes.
anticipate
Okay.
water and sewer? 150?
Yeah, I don't know. It's a 5.3.
Your electric, it's a 5.3. All right, so maybe
Mm-hmm.
200. It depends on the market too. Your
Right.
heat or your electricity and heat itself, your electricity and gas, we're gonna say another 200. I don't know your market though. So some property
Yeah.
taxes cover garbage. Sometimes you pay them separately. It's not usually
Mhm.
that much. It's like, I don't know, $50. I think it's like
Yeah,
35
garbage
bucks.
really cheap.
You're gonna
Internet
have to
like
cover
50.
internet. Oh, you
Yeah.
think 50? Okay.
Mm-hmm.
We don't provide internet there. And then landscaping you're gonna have to do now too. So if you say 50
Yeah.
bucks a month, that's really not a lot for landscaping.
But don't I
Um,
cover electricity for midterm as well?
yeah, I just combined it with your heat here.
Oh,
I
good,
mean,
good. Okay.
it's I just
Okay.
called gas and electric. I mean, we could put. I honestly need to change this now that but
Okay,
there you
got it.
go.
Perfect.
Maybe that's 250. It's a little more. I don't know. And then the big thing here is okay. So it's a 5 bedroom, 3 bath property.
Yes.
So it's going to cost you. So for the 5 bedrooms, it's going to cost you. What do you anticipate it'll cost you per bedroom to furnish? I know on the low end, we're paying like $1,200 at minimum for like a
Yeah.
pad split, bare minimum rental. So you're probably going to pay close to $2,000 a bedroom.
Yes. Yes. Something like that. I think so.
Plus
You're
your
right.
kitchen is going to be a couple grand there. I don't know,
Yes.
2,500 plus your living room, 2,500. I mean, it's like bare bones furnishing, probably $15,000 for a house that big.
Probably 20. I want to say
Yeah,
20.
probably 20. And it's better to over than under
Yes.
estimate for those scenarios. So in that scenario, you have your income, your expenses, your reserves, and your management. So now you're netting $286 a month in cash flow on the worst end, 1186 on the best end. So you're hitting your
Wow, that's a
cash, you're
deal.
hitting it is a deal from a cash flow perspective. You're getting your 4.28%. If you're
Mhm.
cool with that, let's say your goal is 4%. Say your goal is 0%, whatever for cash on
Mhm.
cash. That would make sense for that. We're not worried too much about equity because we didn't get
Yeah.
after repair value, entry
Yeah.
price, fee to purchase price, all this stuff. I don't care about. I just care about what is my cash flow and my returns. And so
Wow.
on the worst case scenario, you're getting 4.28%.
Uh-huh.
Best case, you're getting 17.73%. So realistically, it'll be somewhere between those two for your cash
Nice.
flow. So
No, this is
now
amazing.
up to you. Do you want to, is this
It
one
look
that you want to buy or not?
it
And
looks
then
like
you
a
need to get
deal,
really good
yeah.
with the numbers. Yeah, well,
Yeah.
up to your investment criteria, right? And then it's,
Yeah.
do you want what numbers, do you need to update and get more certain on?
Yeah,
Maybe
yeah.
if they've been operating it and they've been self-managing or they've been covering utilities, you
It's
have
a
that
it's a
info.
primary res. So I mean I can ask what they
So they
would
have
normally
info.
pay. Yeah, they
Yeah,
have
totally.
info. But all that occupied different 5 bodies, maybe
Yeah,
a
the one
bit slightly
caveat I'll
more
put
or less.
is be careful when
Mm-hmm.
you're from experience, be careful when you are underwriting midterm rentals that are really large homes because the
Okay.
most common bedroom, and you can look this up on Furnish Finder, they have data and analytics, you can look there. The most
Okay.
common are studios, 1 bedrooms and 2 bedrooms, maybe
I do
three
see
bedrooms
that.
because it's a working professional
Mm-hmm.
and then maybe their partner, maybe they got a pet or two. When the house gets too big for midterm rentals, it's
It
not
might be too much.
yeah, it's just a smaller audience that needs a 5 bedroom house and they're
What
healthcare
can you do?
professional or military or
Can you
whatever.
do rent by the room? I do see that as well. It's almost like pad split, but not because they keep the common area, right? If you rent by the room.
You could rent by the room, but just
Yeah,
different
I do
level of
see that.
management.
Got it.
For
Okay.
this example,
Hmm.
we're going to move on to the next deal.
Okay.
I will
Thank you so
put this
much.
in there for you. You could just grab this.
Will I be able to play with the Excel once you
Yeah,
put
this
that
is
on
yours.
there?
I'm done. Yeah, I'm done
Yay.
with this. So I'm going to
Thank
paste it in
you.
here. You have fun with that.
Awesome.
I'm not going to delete it, but you download a copy for yourself because eventually I will delete it.
Okay.
Cool.
Perfect. Thank you so much.
Cool.
Appreciate it.
No worries. All right, we're going to do one more and then I'm going to spend some time with my wife. So Dimitri, what you got?
Thank you.
Bye, Christine.
Thank you.
Hi guys, thanks Michael for doing this. A lot of
Of
gems and
course.
stuff. Quick question. So it's a seller finance deal.
Okay.
Seller wants 140,000. It's a
Mhm.
6 bedroom. So they're doing they're renting by the room. And the property makes $1,953 a month.
Okay, wait, sorry, let's go through that. So seller finance,
Yes.
and you said the loan is how much?
It's no loan. I mean, purchase.
Well, it's your
I mean,
loan
he
to
wants.
him. Yeah.
Yeah, he wants 140,000.
All right, so that the purchase price is 140.
Yes.
And then how much money are you giving him down?
He's asking like for 20,000.
Okay, not too bad.
And 3-year balloon he wants.
Not very good, but depends. I mean, that is good to highlight. Okay. And then I can show you some fun stuff on the amortization calculator from that. You said what's your income?
$1,953 a month.
Okay, and that's rent by the room, you said?
Yes, it's a six bedroom.
Do you mind me asking where this is, the market?
It's in Ohio.
Okay, I'm gonna say that's a weird, that's a big old house and not, yeah. Got it. So down payment. All right, so let's just start underwriting just to go through the exercise. So you said the purchase price is 140,000.
Yes.
All right, so what's that, like 15%? Okay, we're gonna set it at 20,000. We're gonna put the down payment is just a percentage that 20,000 divided by 140 is 14.29% down payment. So because there is no loan, it's a straight sub-2 deal. All you got to do is change your monthly payment or you change your original loan amount to 0, and you change your sub-2 loan amount to 0. Now this is just the seller finance calculator. That's all we did. The purchase price minus your down payment. The rest is a seller finance loan. Do you know what his monthly payments are, interest rate? What is he looking for? Or are you trying to figure that out?
I mean, yeah, kind of like he's not sure yet, but I would say he's probably looking for like 4% yearly.
And we can adjust it after, right? Okay, so you said the property generates 1953, not profit, right?
Yes.
That's the rental income.
Yeah, that's the income, yeah.
All right, I'm not going to get into the weeds about per room and all that. We're just going to look at the high level. So in this example, you're paying $573 a month to him. You've paid $20,000 for the down payment. So do you have anticipated taxes and insurance for the property?
I know like the gross operating like profit each month $1,347, but I'm not sure about taxes yet.
I mean, okay, so gross operating profit. What'd you say it was?
1347.
Okay, and I'm assuming obviously he owns it outright. So in his rental, so his income is 1953. That means his expenses are 1953 minus 1347. He's paying $606 a month.
I just
That's
checked
what we have from there.
1,400. It's a property tax on the property.
Okay.
Yeah.
We'll just assume that's good for now. You're going to want to understand what it is once you buy the property, and it's reassessed at that value, unless the assessment value is at this value, but it's probably at a lower value than that. So you probably will be higher than that. But let's move on from there. So of the 606, we're going to say, I'm just working with what info you got from me. So your expenses, it's that amount minus your taxes, minus your insurance. There's another $364 approximately that he's paying in utilities. So let's try to get close to that. So you have, it's Ohio, so I don't know, $100 for water, $100 for gas and electric. All right, you're gonna just watch me do this real fast.
But he included the electric, gas, and water in those 1,300.
Yep.
Monthly.
Oh, wait, I might have misunderstood what you said. Did you say this is his gross operating profit or expenses?
I mean, that's what it says on his paper, gross operating profit, 1,300 monthly.
So that means that's how much he's making a month, right? So we're taking the income, we're subtracting what it's expenses.
Yeah, the income is 1,900 and the gross operating profit 1,300. I mean, that's not the profit, that's expense.
The expenses. That makes more sense. All right, so
Sorry.
we're gonna, it's okay. So the income minus the expenses, well, that's okay. So we don't even need to do all this. So he's paying 1347 a month. I can tell you it's probably not going to be a deal because there's not a lot of spread here for then, because this gross operating expense is assuming he's paying no monthly mortgage payments. So whatever mortgage payment you add here is going to be tough, but let's run it and see. So his taxes and insurance, so this amount should equate to that 1347. Right. And I'm just going to separate this 1347 in between these. So he's got gas, electric, you have garbage, I don't know, $30. You have internet. I'm assuming he covers internet for rent by the room. Landscaping. So this amount, your taxes, insurance, water, gas, electric, garbage, internet, landscaping, is $721. So we're still missing $600. Do you know what he's paying for? Or which of these seem lower than they should be? If he's paying $1347 a month in expenses?
I'm not sure exactly.
All right, well then we're just gonna fake it. And I don't know where it's going to, but actually, whatever. It'll just go into other.
No, but oh, Mike, were you asking me? Oh yeah, the water is
oh yeah,
212.
there we go. Okay, gas and electric.
Gas is 174, and water, sewer, and trash 219. It's together.
Water, sewer, trash. Okay.
And that's it.
Internet, landscape. I mean, I don't understand how he's paying.
I believe
1347 a
internet.
month. What's
I
he
mean,
paying
they
for?
paying the renters paying for the internet, but yeah, the landscaping he pays. I'm not sure.
But you said there's 1347 a month. Oh, is this gross operating expenses? That's how much he's spending each month for this property.
Yes.
If he doesn't have a loan in place, he's paying it on taxes, insurance, utilities. That's his expenses. Maybe property management as well. Right? Do you get what I'm saying? Like if he's spending 1347 a month in expenses, we have to calculate where that is here. I don't actually care for this example. So we're going to say this amount is 846. So we're going to say equals 1347 minus the sum of these values. So we're going to subtract away this value minus the sum of these values. So $350 is what was missing from what he's paying a month. So these numbers now are 1347. You still have, do you know if that includes property management or no?
I believe he manages himself.
Okay. So is that what you're going to do? I don't think so. Right.
No, I don't. And I mean, the internet, I believe all the people paying, the renter who rents the rooms, they paying.
It doesn't, you can ignore all of this info, what it's categorized as. I just have this equals 1347 because that's what he's paying in expense each month. If you don't have a better breakdown, I can't, split it up than that. We just know he spends 1347 a month.
Yeah.
I would figure out what he's spending $1347 a month on is what I would ask. It could be that this was.
That's what it says. Only like electric, gas, and water, and trash and sewer. That's what it is.
I don't, but that doesn't equate to the gross operating expenses.
Yeah, I got
so it could be the taxes are way higher. It could be insurance is way higher. I don't know. Yeah. I just have that info. You have your 195 or 10% for property management. You'll probably end up paying more if it's by the room. I don't even know. A lot of property managers don't do by the room. So be cognizant of that in your market. Call property managers to see if they'll manage it for you. Vacancy, maintenance, and CapEx, I'd still leave it at these same amounts. You're probably going to have, rent by the room is a little different. So, all right. There's no arrears or liens. Is there an agent involved? I don't think so.
Yes, the agent involved. Yeah.
Oh, there is?
Yeah.
Is he going to pay the agent out of that 20,000? Are you going to pay the agent? How much are you paying the agent?
I mean, it's like 3%, but I don't think so. He's gonna pay it. He wants me to pay it because he's giving me the seller finance terms and stuff.
Okay. We'll assume the property's turnkey. It's good to go. Closing costs, I'm assuming he wants the same. He wants you to pay it.
Yeah.
If he made that case. We could even change this to zero. I mean, you'd probably put it under an LLC. It's going to cost you some money to set that up. Are you buying this from a wholesaler or is this your deal? It sounds like your deal.
Yeah, it's through the agent, yeah.
Okay. And then we'll just set 1 month of carrying cost. Sounds like there's already tenants in there, correct?
Yes.
So all in, you're going to put $30,820 down. Oh, let's set this seller finance monthly payment. Let's set this to 0 for now. So there's no seller finance payment, and we'll see how much you could possibly pay him. Okay. So, because, well, let me show you why I did that. You said 4% is probably what he wants. That's what I'm saying. This is already not a deal for certain, but we can see how can we make it a deal, right? And you can explain to him, this is the only way this actually allows me to make money and the returns I need. If this works, awesome. If not, cool. I'll move on to the next guy. So your income is 1953, especially because it's rent by the room. I would not anticipate it being higher than that, because it's more likely lower than that as a long-term rental. Your expenses are 1920 a month, which includes your seller finance payment, taxes, and the 1347 we talked about, and then your property management and reserves. In total, you're losing $514 a month. So you need at least to pay $514 less to at least be 0, right?
Okay.
So the cool thing about seller finance is you can negotiate more of it, right? So let's see what your seller finance payment is. Your seller finance payment is $572. So the difference between 572 minus 514 is $60. So you can only pay him up to $60 a month just to break even with your reserves accounted for.
Yeah.
This is why it's so important to underwrite deals that may seem like they'd be good. $20,000. I almost got into a house the other day for $13,000. Big old nice house, but it's going to lose me over $1,000 a month. It doesn't make sense for my investing goals to lose $1,000 a month, even if I can buy a house for cheap. So it's ultimately up to you with the information you have here, what you want to do. Even if you gave him 0% interest and set this up as a 60-year amortization, so you pay him very low amount per month, or let's, even at 80 years or 100 years amortization, you're still not, and he wants you to pay him back. He wants a balloon in 3 years. It's going to be really hard to refinance this property in 3 years. You're not going to pay off enough principal on the debt to do that. You're not going to, it's probably not going to appreciate enough in value. You're probably already slightly overpaying him, maybe because he's giving you seller finance. He sounds like a very savvy investor. And those are the big two. Those are the big, and refinance, your lender is not going to say, they're not going to allow you to refinance unless the property is, the loan you're going to take out is 75% of the value of the property. They're probably not, did I kind of explain a variety of reasons why this may not work? I'm going to put this back to what your terms were, and I'm going to drop this in the chat for you. Are there any questions about this that I can try to answer for you?
You said it like pretty clear, so that's not actually a deal. So I'm just gonna move on and stuff.
And I'll tell you how I knew that from the beginning. If your income is 1953 and your expenses are 1347, without accounting for reserves, maybe this 1347 is he put a bunch of money into rehab and renovations. Maybe he did pay a property manager. I don't know. So you really want to understand what makes this up. Maybe he spent $50,000 renovating the place. Well, he didn't, but maybe he spent that times 12. $10,000 renovating the place this year or something. So that was why this looked higher when you divide it by 12, for the monthly. Maybe, but I knew just between this split, once you account for your reserves, all that, and you have to pay him, there's no way. So this is good for him. He makes $600 a month, but that $600 a month that he makes, like, you'd have to give him all of that.
Mm-hmm.
Basically, the $600 you would make in his shoes. So it could work for him because he owns the property. It wouldn't work for you if your goal is to cash flow on it, which I assume it is. And why would you waste $31,000 to do that when you could probably just buy something else that does work?
Yeah.
That's why it's so important to be able to underwrite well, but fairly quickly as well, so you can take action and not waste your time on things that don't make sense.
That's gold. Thanks so much, Michael. Really appreciate it.
Cool, no worries. Christine, is this a legacy hand? Christine, you got
So
something real quick?
sorry. I'm sorry.
Okay.
I gotta take it down.
You're good. Are we good? Oh, okay, cool. All right. Thank you, everyone.